Ray Dalio said something recently that should send shivers down the spine of every homeowner and real estate investor. Buying and holding real estate is not an effective investment strategy in our current economic environment. Here's why. Real estate is more interest rate sensitive than it is inflation sensitive. That's counterintuitive for many. People assume real estate always goes up during inflation, but the reality is more nuanced. From 2021 to 2024, as you can see here, US CPI rose over 18%. And you'd expect home prices to at least keep pace, which they did. You could see here, they rose 56.2% from 2020 to May 2025, whereas CPI rose 25%. But during that same period, mortgage rates more than doubled from 3% to 7%, as you can see here. And that had a far greater impact than inflation alone. Why? Because housing is primarily bought with debt. Mortgages, loans collateralized by the property, amplify the effect of interest rate moves. When rates rise, financing costs surge, killing demand. The market doesn't care about inflation when the monthly payment has doubled. Every 1% increase in mortgage rates cuts affordability by about 10%. So a move from 3% to 7% slashed about 40% from the average buyer's budget. Add that to 25% inflation-adjusted home price appreciation over the same period, and you can see why home affordability is in the gutter. And this rate cycle isn't over. The Fed's policy rate is still at 4.25 to 4.5%, with inflation steady at 2.7%. Even if rates drift lower, they're not returning to the near zero levels that supercharged housing prices for the last decade. That tailwind is gone. The second reason is that real estate is easy to tax, and governments are desperate for revenue. Look at the fiscal position of the United States. We have $37.2 trillion in federal debt, growing at roughly $1 trillion every 100 days. State and local budgets are bleeding from pension obligations, Medicaid, and infrastructure, and the Social Security Trust Fund is slated to run out in less than 7 years. And what's the easiest target for desperate politicians? Property. You can't hide it, you can't move it, and you can't store it offshore. Property tax rates have been rising nationwide. In New Jersey, the effective tax rate is 2.46%. In Illinois, 2.05%. Even California's low Prop 13 rate hides massive supplemental fees. In Chicago, homeowners saw average tax bills jump 94% over the last 20 years, almost 5% per year compounded. That's a permanent drag on your investment. And it gets worse. Cities are adding vacancy taxes, landlord taxes, and mansion taxes, all designed to milk fixed assets that can't move. Reason number 3 is real estate is nailed down, literally. When capital controls hit, when your state hikes taxes, when local politics turns hostile, you can't take your property with you. We've seen this movie before. Argentina. Capital controls in 2011 froze US dollar access, and real estate owners were stuck. In Canada, the foreign buyer's tax in Ontario and British Columbia up to 25%, instant value destruction. And in China, entire cities like Shenzhen saw real estate frozen in liquidity crises. Real estate is location dependent, jurisdiction dependent, and exposed to confiscation risk, not just through outright seizure, but through punitive taxation. And reason number 4, the collapse of office real estate. Commercial real estate, once a pillar of investment portfolios, is in structural decline. You can see on this chart, office construction plateaued in 2020, then collapsed. Annual spending has fallen from $70 billion in 2023 to just $43 billion today. At the same time, data center construction has surged from $12 billion per year to roughly $40 billion. In the coming months, spending on data centers will overtake office construction entirely. And the reason is simple, and it's not going away. Remote work is here to stay. Office vacancies in major US cities are at all-time highs, commercial real estate portfolios are bleeding, and refinancing at today's rates is crippling landlords. Many office towers are now worth less than the debt they have. This is the broader point. Not all real estate is created equal, and much of the traditional portfolio exposure, especially in office space, is dead money in 2025. So what's the alternative? Bitcoin. And not in the lazy buy it because it's trendy sense. I mean as a strategic reserve asset that solves every weakness real estate has. It's portable. You can move $100 million in value across borders in 10 minutes with no permissions needed. It's inflation resistant. There are only 21 million that will ever exist, and only 438,396 BTC will be issued over the next 2.5 years. It has a predictable supply schedule. Tax optional mobility. Its jurisdiction risk can be actively managed because you can change custody locations without selling the asset. And more importantly, it's liquidity without leverage. There's no mortgage needed to access global liquidity. These markets are open 24/7. Bitcoin's 10-year compound annual growth rate is 84%. real estate is projected to be about 5% nationally between 2025 and 2035. That's 16 times higher annualized growth without the maintenance, taxes, and liquidity of a house. Even in the last 3 years, through inflation, rate hikes, and recessions, Bitcoin is up over 300%. So it's better to buy digital real estate. Digital property that can't be taxed into oblivion by a single local jurisdiction. It can move anywhere instantly, and it's scarce, verifiable, and globally liquid. Your house might be a home, but as an investment in 2025, it's a sitting duck. At least until now. With Horizon, you can use your physical real estate to acquire digital real estate without selling your home or taking out a loan. That means you can keep the roof over your head while stacking Bitcoin for the future. Because in this economic environment, the most dangerous words are, "I'm all in on property." That's all for today's video. Thank you so much for watching. If you enjoyed, make sure to like and reshare, and of course, follow for more. And check out Horizon. Horizon lets you stack Bitcoin using your home equity without new debt, monthly payments, interest charges, or term limits. You can check that out at joinhorizon.com or by just scanning the QR code right there. That's all for today's video. Thank you so much for watching. I'll talk to you soon.